Hey everyone, welcome back to Tesla Daily. Today is March 5th, 2026. We've got a lot to cover, so let's jump right in. First up, we're seeing some exciting developments with X Money as it launches as a super app. This could really shake things up in the financial landscape. On a different note, Elon Musk is facing some legal challenges. It's always a bit of a roller coaster ride with him, isn't it? And over at Giga Berlin, we've hit a bit of a snag with a union defeat. It's a tough situation, but we know these things can be part of the journey. We also need to talk about a setback regarding carbon credits. This is definitely something to keep an eye on as it could impact our sustainability goals. And while we're at it, we're noticing a decline in sales. That's not great news, but let's remember that the market can be unpredictable. All right, before we wrap up, let's take a quick look at the stock. Stay tuned for that. Let's take a moment to check in on Tesla's stock. As of March 5th, 2026, it closed at $405.40. That's a nice little bump, up nearly 1% for the day. It's always encouraging to see the stock move in a positive direction. Let's keep an eye on how it performs in the coming days. Tesla is facing significant challenges as its sales continue to decline, raising concerns about its future in the increasingly competitive electric vehicle market. Recent reports indicate that Tesla's global sales fell by 9% in 2025, with U.S. sales dropping 7% from the previous year. In California, Tesla's largest U.S. market, its share of new vehicle registrations fell from 11.6% in 2024 to under 10% in 2025, according to the California New Car Dealers Association. Former Tesla owners cite various reasons for their departure, including polarizing leadership, aging vehicle models, and inadequate customer service. Tom Libby, a consultant at S&P Global Mobility, noted, "Back then, the brand was more than just the vehicle, although they are not necessarily at the forefront anymore." In the UK, Tesla's registrations plummeted by 41% in the first 2 months of 2026 compared to the same period in 2025. According to the Society of Motor Manufacturers and Traders, SMMT. Despite the overall new car market seeing a 7.2% increase, Tesla's sales fell sharply, with February sales dropping 37% year over year. The company has disputed these figures, arguing that quarterly sales are a more accurate reflection of its performance due to its unique distribution model. Tesla's brand value has also taken a hit, dropping to $27.61 billion in 2025, a 36% decrease from 2024. This decline comes as the company lost its title as the top all-electric seller to Chinese rival BYD. However, Tesla is attempting to pivot towards new opportunities, including its robotaxi services, which analysts believe could help regain its competitive edge. Despite the current downturn, the broader EV market is growing, with over 20% of new cars sold worldwide being electric as of 2024. This shift indicates that while Tesla faces challenges, the overall demand for EVs remains strong. As competition intensifies, Tesla's ability to innovate and adapt will be crucial in maintaining its market position. In conclusion, while Tesla is currently experiencing a decline in sales and brand value, the long-term outlook for the EV market remains positive. The company must focus on addressing customer concerns and enhancing its product offerings to reclaim its leadership position in the industry. Now, let's shift to the next story. In a bold move that could reshape the electric vehicle landscape, BYD has unveiled its second-generation Blade battery, which boasts the ability to charge from 10% to 70% in just 5 minutes and reach 97% in 9 minutes. This revolutionary technology positions BYD as a formidable competitor to Tesla, particularly in the fast-evolving EV market. The newly launched Denza Z9 GT, equipped with this advanced battery, offers an impressive range of 644 miles, 1,036 kilometers, on a single charge, significantly surpassing Tesla's Model Y, which provides approximately 357 miles, 575 kilometers, for a higher price of $44,990. The Z9 GT starts at a competitive price of $39,150, making it a compelling option for consumers seeking both affordability and performance. BYDs. Next up, another key development. Tesla is making significant strides in its production of the electric semi-truck, with the recent launch of mass production at its dedicated factory in Nevada. This factory, part of a $3.6 billion expansion, is designed to meet the growing demand from logistics partners, including companies like High Logistics and DHL. CEO Rudy Diaz of Height Logistics recently confirmed that they have added a Tesla Semi to their fleet and plan to acquire more, stating, "Proud to have participated in TPM by delivering a container for one of our customers to the conference. This move also gave us a chance to highlight our new Tesla truck." The Tesla Semi, which was first unveiled in 2017, officially entered limited production in. Now let's shift to the next story. In recent developments, Tesla has rolled out significant updates and service bulletins affecting its vehicles, particularly the Cybertruck and Model Y. Notably, the company has activated a hidden feature in the Cybertruck, introducing active road noise reduction through software version 2026.2.6.1. This advanced cabin noise cancellation technology utilizes embedded seat microphones to monitor and counteract low-frequency road noise, enhancing the driving experience on rough surfaces. As stated in Tesla's release notes, your vehicle now has the ability to actively reduce low-frequency road noise while driving on rough surfaces. This feature aims to improve comfort for drivers frequently navigating challenging terrains, making long drives more enjoyable. On the service front, Tesla has issued several bulletins addressing specific issues in the model. Here's the next update you should know. Tesla is at a pivotal moment as it continues to evolve from a traditional automotive company into a leader in artificial intelligence and robotics. While the company has made significant strides in its full self-driving FSD technology, challenges remain, particularly in the competitive landscape of autonomous vehicles. Notably, Tesla has yet to expand its robotaxi services beyond Austin, while competitors like Waymo are rapidly scaling their operations, aiming to operate in 26 cities by year-end. This competitive pressure highlights the urgency for Tesla to enhance its FSD capabilities and expand its fleet. In the realm of robotics, Tesla's ambitious plans for its humanoid robot Optimus are underway. The company is exploring mass production readiness and the potential for these robots. Here's the next update you should know. Tesla is undergoing a significant transformation, pivoting from its traditional electric vehicle EV focus towards ambitious projects in robotics and artificial intelligence AI. This shift comes as the company grapples with declining vehicle sales, losing its title as the world's largest EV seller to BYD, which sold 2.25 million vehicles in 2025 compared to Tesla's 1.64 million. Despite this setback, optimism remains high regarding Tesla's future, particularly its robotaxi and humanoid robot initiatives. Recent research from Bank of America indicates that the robotaxi business now accounts for over 52% of Tesla's overall valuation, a stark contrast to the 21% attributed to its core vehicle sales. Analysts predict that Tesla could capture 50% of the global robotaxi market by 2030. With next up, another key development. In a decisive move, Nashville's Metro Council has passed a resolution opposing Elon Musk's Music City Loop, a proposed underground transit system designed to connect Nashville Airport to downtown. The vote was 20 in favor and 15 against, with 2 abstentions, but it's crucial to note that this resolution holds no power to halt or alter the project, which is already under construction by the Boring Company. The Music City Loop is intended to alleviate traffic congestion by providing a swift transit option, with a projected travel time of just 8 minutes over its 9.5-mile route. However, the project has faced significant backlash from local officials and residents alike, primarily due to concerns surrounding safety, environmental impact, and the lack. In recent developments, we are witnessing a growing backlash against Tesla's supercharger stations, particularly in San Francisco's Cow Hollow neighborhood. Residents have described the scene at the 24/7 supercharger station at 1965 Lombard Street as a nightmare, citing nightly congestion and disruptive behavior from drivers. Laurel Calzoni, a local resident, expressed her frustration, stating, "Peaceful enjoyment of my apartment has been non-existent. The noise levels, particularly from loud music played by Tesla drivers during late-night charging sessions, have led to complaints about the quality of life in the area. This situation is compounded by trench work related to the supercharger installations, which has caused multiple planned outages from utility provider PG&E, affecting residents without any compensation. While Tesla's supercharger network next up, another key development. In a significant development for Elon Musk's vision of an everything app, X-Money is set to redefine how users interact with financial services on social media. Currently in beta testing, X-Money allows users to send and receive money, store funds in a digital wallet, and make peer-to-peer payments directly within the X app. This service is being developed in partnership with Visa and has already secured money transmitter licenses in over 40 U.S. states. William Shatner, who is promoting the beta rollout, revealed that X-Money will offer an attractive 6% annual percentage yield on deposits, alongside features like a metal debit card with cashback and zero foreign transaction fees. You will receive a $25 welcome gift from the wonderful team at X, Shatner tweeted, highlighting the incentives for early adopters. The app's interface is designed for simplicity, featuring tabs for account, rewards, and activity, making it easy for users to manage their finances. Speculation is rife regarding potential cryptocurrency integration, with analysts predicting that X-Money could soon support asset management and stock trading directly within the platform. As one analyst noted, Elon literally said this is meant to be the central source of all monetary transactions. Musk's ambition is clear: to push X's monthly active users beyond 600 million. Drawing comparisons to China's WeChat super app model, this could significantly increase user engagement and retention, as users would spend more time within a single environment for both communication and transactions. The integration of financial services into a social platform could change the landscape of digital transactions, potentially leading to higher monetization and market influence. As we look ahead, the success of X-Money will depend on its ability to attract users and navigate regulatory landscapes. If successful, this could position X as a formidable player in both the social media and financial services sectors, reshaping how we think about online interactions and transactions. The future of X-Money is promising, but it will require careful execution to realize Musk's ambitious vision. Next up, another key development. We find ourselves in a pivotal moment for Elon Musk as he faces a class action lawsuit from Twitter shareholders, alleging that he manipulated the company's stock price during his tumultuous acquisition process. This trial, which is set to last 3 weeks, is not just about Musk's actions. It raises critical questions about accountability in the age of social media and its impact on market dynamics. Musk's legal woes stem from his controversial tweets and public statements made between May 13th and October 4th, 2022, when he initially proposed acquiring Twitter for $44 billion at $54.20 per share. Investors allege that his comments led them to sell their shares at a loss, believing he would not follow through with the deal. "I got screwed. I got cheated," lead plaintiff Brian Belgrave stated in court, highlighting the emotional toll of the situation. During his testimony, Musk defended his social media presence, arguing that his tweets are merely personal thoughts and not calculated market maneuvers. He stated, "People tend to read too much into things that I do," emphasizing that he did not intend to mislead investors. However, he acknowledged that he may have used a negotiation strategy that involved publicly undermining the deal to gain leverage, complicating his defense. The trial's implications extend beyond Musk himself. It challenges the existing regulatory framework that governs market communications. Traditional securities law was designed for formal disclosures, but in today's digital age, a single tweet can sway billions in capital. Musk's case could set a precedent for how social media interactions are interpreted in the context of securities law. As we watch this legal battle unfold, the long-term outlook for Tesla remains cautiously optimistic. While Musk's legal challenges may create short-term volatility, Tesla's robust vehicle production and advancements in automation and AI continue to position the company for growth. The ongoing development of full self-driving technology and the expansion of its energy infrastructure could bolster Tesla's market cap, even as Musk navigates these turbulent waters. In conclusion, while the current legal challenges are significant, they also reflect the evolving landscape of corporate governance and investor relations in the digital age. We will continue to monitor the situation closely as it develops. Next up, another key development. In a significant setback for the IG Metall union, Tesla's Gigafactory in Grünheide, Germany, has rejected union influence in recent Works Council elections. The union, which aimed to secure a majority in the council, only managed to obtain 13 out of 37 seats, a drop from 16 in the previous election. This result leaves the factory without a collective bargaining agreement, a distinction Tesla has maintained since its opening in 2022. The Giga United list, aligned with management, won 40.4% of the vote, marking a clear preference among employees for an independent approach to workplace governance. With over 10,700 employees eligible to vote, turnout was impressive at 87%. This election outcome has been framed by Tesla as a vote for flexibility and autonomy, with plant manager Andre Thierig stating, "This is a clear message by the Giga Berlin team towards an independent co-determination." However, the election was marred by accusations of intimidation and unfair practices. IG Metall has claimed that Tesla engaged in tactics to undermine their campaign, including holding anti-union events and suggesting that expansion plans would be jeopardized if the union gained power. Elon Musk himself warned employees in a pre-recorded message that we will not close the factory, but realistically, we will also not expand if IG Metall gained influence. The union's defeat is particularly notable against a backdrop of significant operational challenges at the plant, which is reportedly running at about 40% of its intended capacity. This situation has led to job losses and heightened scrutiny of working conditions, with IG Metall alleging that Tesla has unfairly scrutinized sick notes and conducted unannounced home visits. As we look ahead, the implications of this election could be profound. The absence of a collective bargaining agreement may allow Tesla to maintain its current operational strategies, but it also raises concerns about employee rights and workplace conditions. The ongoing legal disputes between IG Metall and Tesla, particularly surrounding allegations of union busting, suggest that this conflict is far from over. The long-term outlook for labor relations at Tesla's Berlin plant remains uncertain, as both sides prepare for what could be a protracted struggle for influence and rights in the workplace. Now let's shift to the next story. In a significant blow to Tesla, we have learned that both Toyota Motor Corporation and Stellantis NV have exited the company's carbon credits pool in the European Union for 2026. This development marks a pivotal shift in Tesla's revenue strategy, which has heavily relied on emissions credits to bolster its financial performance. The absence of these two automotive giants, who were previously key players in Tesla's emissions pooling arrangement, could lead to a substantial loss in revenue. Historically, Tesla has earned nearly $12.4 billion from regulatory credits since 2017, with approximately $2 billion generated in 2025 alone. Analysts had previously estimated that Tesla's carbon credit arrangements could yield over €1 billion annually in Europe. However, as Toyota and Stellantis seek to meet their CO2 emissions targets independently, the need for Tesla's credits diminishes. The European Union allows automakers to join emissions pools to meet strict fleet-wide carbon targets. By pooling their fleets, companies with higher emissions can offset them by partnering with lower-emission manufacturers like Tesla. However, as legacy automakers ramp up their electric vehicle production, they are becoming less reliant on purchasing credits. Toyota, for instance, has expressed confidence in its ability to meet emissions targets through its expanding lineup of electric vehicles, including the BZ4X. Meanwhile, Stellantis aims to establish its own independent pool with its subsidiary Leapmotor, which has recently entered the European market. This exit from the carbon credits pool comes at a time when Tesla is already grappling with declining sales figures, particularly in Europe, where sales have plummeted by over 17%. As competition intensifies, particularly from rivals like BYD Co. Limited, Tesla's reliance on carbon credits as a revenue stream is becoming increasingly precarious. Despite the current challenges, the door remains open for Toyota and Stellantis to rejoin the pool until December 2026, which could provide a glimmer of hope for Tesla's financial outlook. However, the long-term implications of this exit could reshape the landscape of carbon credit trading and Tesla's revenue model. As we move forward, it will be crucial for Tesla to diversify its revenue streams beyond carbon credits to maintain its market position and profitability. And that wraps up our update for today. Thank you for joining us for Tesla Daily Insights. We appreciate your support and enthusiasm. We'll catch you in the next update, so stay tuned.